The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Before we get into the charts that matter, let's just have a look at what traders are watching out there. The agreement between President Trump and British Prime Minister Keir Starmer amounts to a limited bilateral trade deal where the 10% tariffs on British exports will remain in place while modestly expanding agricultural access for both countries and lower duties on British car exports. The US will cut tariffs on British car imports to 10% from the current 27.5%, which will apply to a quota of 100,000 British vehicles. Meanwhile, tariffs on British steel will fall to 0 from 25%, and both sides have agreed to new reciprocal market access on beef. President Trump saying that Britain, quote, made a good deal and that many other trading partners may end up with much higher final tariffs because of their large US trade surpluses. Meanwhile, the Bank of England cut its policy rate by 25 basis points to 4.25%, as widely expected. The statement seen as hawkish, emphasising that additional easing should be gradual and careful. And both Norway and Sweden central banks held their rates steady. We saw US Treasury yields touch multi-week highs, the US-UK trade deal spurring optimism that similar agreements will be struck. And the US two-year Treasury yield rose to 3.9%, the 10-year rose to 4.38%, and the US dollar index gained against the safe haven yen and Swiss franc, while the British pound fell in the wake of the rate cut. We've got our Aussie dollar there, just under 64 US cents. Bitcoin, though, look at that, back above 100,000 US dollars a coin. Let's look at all the technicals now. Ilya Spivak from Tasty Live joining us. Always great to see you, Ilya. Another big week since we last spoke. So in terms of what we're seeing with the S&P 500, it's almost as if Liberation Day didn't happen.
Very good to be with you as always, Juliet. And yes, indeed, if we take a look at the S&P 500 here as a kind of general barometer of market risk appetite, it's very interesting where we've arrived and, of course, where this leaves us, because it's as though, as you just said, Liberation Day didn't happen. So the markets had their hair on fire moment where for a second there it looked like the U.S. might be in the midst of a genuine sovereign or even a currency crisis. Of course, cooler heads prevailed, and we have returned basically to exactly that starting line. But the key here seems to be that this leaves us with the same recessionary concerns that took the market down in the first place from mid-February to mid-March.
All right, so that's kind of the overall momentum and where we're kind of looking for some more impetus on markets. But as we know, Ilya, it's all about the bond market. So as the Fed this week mentioned that it was going to hold and we're going to be patient, are bonds ready to recover here?
I think we have an interesting situation here that's very similar to what we saw last year when the Fed was resistant to cutting rates at the start of the year. And if we are indeed back into a just regular recession, not some sort of sovereign crisis in the U.S. type of a situation, well, then the move from about 115.08 to 112.05, again, in that mid-February to mid-March episode, that's instructive. And that starts to tell us that if the Fed is resistant to cut now, as they were at the beginning of last year, then the markets are going to reckon that they're going to be behind the ball and they're going to have to cut more later. And so what that should begin to reflect is a higher long bond. And so I'm looking at this 115.08 level as a kind of line in the sand here. If we can get through that and into the 117 high there again, we'll be looking at, of course, significantly lower rates. And this speculation that the Fed has a lot more easing to do once it feels it has the clearance to do it.
Okay, well, we've been watching very closely all of this in Australia, as has everyone, Ilya, but also this week, China announcing further stimulus, which always moves our dollar. We saw it above 65 US cents earlier in the week. What are the technicals showing us about the Aussies' relationship with the greenback?
Well, this is, of course, one of the more interesting indicators in the markets here because the trade deal that really matters isn't the U.S. and the U.K., it's the U.S. and China. There's, in the words of Treasury Secretary Scott Bessent, effectively an embargo at both ends of the most important supply chain link in the entire global system. And of course, we have Mr. Bessent in Switzerland this weekend talking with the Chinese delegation about maybe unsticking this somewhat. Very interestingly, while stocks have, of course, come back from April's lows, bond markets have stabilized, the dollar has never really reclaimed much ground. It's a little bit higher over the past day or two, but the sort of spectrum of currencies, the Aussie, of course, among them, still much stronger. I think that reflects this idea that more rate cuts are in fact coming, no matter what happens with the trade side of the story, whereas the RBA is a little bit slower moving. So we've seen the dollar strengthen a little bit around the idea that maybe we get some productive talks with China this weekend, but that support there at 63.47, that's holding firm. And unless we get underneath there, the story is very much constructive because it looks like what we'll probably see is, at this point, all three major global economies, China, the Eurozone, and the U.S., converging on standstill, and whatever talks may produce near term, a global recession at this point looks relatively inevitable. The question is, will it be severe, and can it be kept short? So the story here will be of Fed rate cuts sooner rather than later, and that should be supportive for all the major currencies, and of course the Aussie among them.
Ilya, you make a good point as we look ahead to these talks in Geneva at the weekend, and given that you still have one more session, the Friday session on Wall Street, do you think more broadly people are going to be a little bit hesitant about putting too much money on the table, or taking some risk off the table, I should say, ahead of these talks?
I think that would be the path of least resistance here, because if we consider what's actually occurring, we just had Chinese PMI numbers come out this week. They put the economy at standstill. It's been in economy-wide deflation now for 8 consecutive quarters, which speaks to an absence of demand. The latest PMI numbers out of Europe and out of the U.S. paint a story of standstill. Of course, the U.S. was the big outperformer last year. No more. You have a 17-month low on global PMIs from S&P Global and JP Morgan. So the march toward recession is already underway. Now we look at this situation with the UK. So tariffs have only gone up 5-fold from about an average of 2% to about 10. Okay, that's not exactly a good story, even though it's not as bad as it could be. It'll still be an important hurdle for growth, and it does signal that the administration is serious about a 10% floor. If that extends to China and ultimately leads to at least slow going on those talks, the economic damage is only multiplying in real time. So it makes sense to think, well, if the markets were concerned about recession in the mid-February to mid-March period, none of those concerns have become better. It's just we've stepped back from the breach of sovereign risk in the world's largest economy and the issuer of its reserve currency. Good news, but hardly avoiding of a downturn. And that, of course, speaks to a level of realization and a level of de-risking in markets that still looms, no matter what these talks result in or don't.
Indeed. All right. Well, we live to see another day of more volatility. Ilya, always a pleasure. Thank you. Have a great weekend when you get there. Ilya Spivak from Tasty Live. That does it for this edition of The Trade. Be sure to join us on Monday.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.